pre-Fed event thoughts for the stock market. I'm Rich Paz from Critical Point, 10:27 a.m. Eastern Time, September 20th. Was chatting with affiliates here and running very fast modeling, extremely short-term modeling. And that may be a mistake of doing that on a day of such an important report, because I think most of the well-experienced traders and analysts understand reports cause people to do weird, strange, even dumb things at times, or even if intelligent, they overdo it, they become extreme, aggressive. It can destroy anybody's analysis during the day. And yet, a few days later, you find the market's right back to normal, the analysis is working. So it's very difficult to predict what people will do on a report day. If it's important, and at 2 p.m. we're going to learn whether the Fed Reserve raises their rates or leaves them unchanged, okay? And I don't see why they'd actually lower them. And so that 2 p.m. is Eastern Time, by the way. But the model on an extreme short-term basis, intra-week, more so intraday, is suggesting that the market did bottom for level 3 this week, but is warning it may not bottom to next week, that there's a few more days for something to go wrong and for people to sell. Inside of that, the model's saying a level 4 intra-week type bottom to intraday should be in place at the low of this week, and the swing is up, okay, into near the close today, and it can top then. But it doesn't have to top overnight for the futures, and maybe as late as, say, early tomorrow in the day session for futures and cash. But the point is, it looks like it's suggesting it's not going to top ahead of the Fed and shouldn't really top at the time of the Fed, that it ought to be at least firm, stable to higher, to even much higher, going into the close, would suggest the Fed Reserve won't give enough bearish information for the Fed, for the stock market, or shouldn't. I shouldn't say it will go that way. We don't know for sure. But what it is suggesting, a chance then that maybe the Fed Reserve is not going to raise the rates. We may be looking at, we're basically just studying what the market's thinking right at the moment. It's not fundamental analysis really. It's just what they're doing, okay? And I must say, the reason my affiliates and I got into the discussion, and then I decided that we could have some fun with this, and you may have some fun with it. I don't want you to go out there and aggressively trade off of this, because we could be totally wrong on this assessment. But what encouraged me to speak up and provide this extra little opinion is that some of the big names on Wall Street who deal with fundamental plus technical have come out and said, as of yesterday and even overnight, that short-term to very short-term technical indicators are oversold to quite oversold, and they're thinking that may be a clue that the market has dialed in any kind of bearish input from the Fed, and perhaps even means that people might even like what the Fed says, and they're going to buy stocks, okay? And I agree with that. I've been teaching this for a few years now, even to technical people, that technical people normally don't talk fundamentals all that much, or it's very summarized, simple, that I've told them, be a little brave, that some of these indicators can tell us, maybe not the actual detailed story, but tell us a bias, a trend, a move of fundamentals, to the point of maybe even being able to predict whether a report's going to be positive or negative, or some kind of event that's scheduled, even though you're not really studying the fundamentals and the news itself to try to make that decision. You're just simply looking at prices saying, this market may have already dialed in bad news we haven't even got yet, okay? Or that it's actually going to turn out to be bullish news and the market might be surprised. I think even though there's been very little selling here recently, I think those sellers sold too much. And I think we are setting up that they may like what the Fed says today, and maybe even be a surprise or a surge. But I want to again reiterate here, the reports do weird things at times, or people do weird things relative to report is a more accurate statement. At any rate, we do have a setup that this market might be firm after the Federal Reserve. And that may just mean they get over it. They may slam it down and put it right back up for some reason. It may mean they're just happy-dappy and buy, okay? So, at any rate, I kind of think maybe the Fed might actually not raise the rates. And I think even their comments could be a little bit dovish to only slightly hawkish and maybe even neutral. And I think if it's even slightly hawkish, I think this market's going to get over it. And I think this market wants to go higher in coming weeks. But again, there could be other factors here I don't realize that's going to knock it down over for a few days. And again, maybe I'm wrong. And the market just doesn't like what the Fed says. Okay? Any rate, what I'm looking at is what would make me more comfortable of the possibility of putting this market up is trading over yesterday's high at 4466.36 for the cash S&P 500. Now, we do have a gap higher today off the cash because of the overnight futures strength, and they're trying to pull that down, and I would like to see that gap filled. It's not all that much. You can just assume back to yesterday's closing price or something. So they might put it back down to about 44, 43 or something like that. And I currently have 44.52. But I think later today it starts swinging above 44.61. That's kind of encouraging. And I'm wondering, could the market actually rally into tomorrow or something and not even fill that gap? Because that could make an interesting bullish pattern in that there was also a gap down created yesterday. And they're almost at the same level, creating something of a bullish island reversal chart pattern, meaning yesterday's price action that was down and then up, okay, is off by itself. You can see these little gaps, all right? I don't know as I'd put a lot into that because I've seen these island reversals over the last 3 years. They look bullish, and then the market pulls back anyways, kind of cancels them. But I think more than 50% of the time the market went up anyways after it canceled that bullish pattern. But it is something I think people are probably watching, all right? Now, how much downside or upside if things go poorly here? Well, first of all, let me discuss the upside that I think if we see it trade above the high of yesterday, September 18th, not yesterday. If it trades above 4466.36, we're going to have some upside targets generated to put it back above 4,500, get back up to where it was on September 14th. Now, I'll give you the downside in a minute, but I want to switch over and make sure I'm not missing something here in the futures for ideas of where this market's going. In the futures, yes, we have this scenario that looks like it'd like to go up into the close. So it's suggesting maybe the Fed's not going to clobber investors and maybe even step a little longer. But in the futures, we'd like to see it trade above yesterday or the September 18th high at 45.14.5. A clue we might be on the right track would be trade above 45.09.5. And yes, that can set up objectives to 45.60 based on the December futures here. All right. And the intraday indicators look pretty good, like they've changed their mind here. Then they're a little concerned. They put prices down a little too much. It's like the negative bearish people are more nervous of problems that the Fed might create a bullish scenario. So they're the ones that are more nervous, okay, than, say, the bulls right now. All right, now, let me flip to, I've lost my train of thought here. I was thinking there was something else I wanted to give you, but let's switch over to the daily chart now and the S&P 500. And yes, it can move back to yesterday's close at 43.95, but again, if it wants to move higher, I think we have to consider the 50-day moving average as an upside target at about 44.85, followed by the high on September 14th of 4511.99. Okay. Now on the downside, if it trades below yesterday's low at 4416.61, the market will likely still throw darts to try to find a bottom now into next week. It's not going to say, oh, a brand new level 3 trend is in place. This market's going lower for 2 weeks. It's just not set up for that. The model really thinks there's a serious setup for a bottom here. But it is short term, and it is still has some time to bottom out. But what would concern some, I think, if it takes out yesterday's low of 4416.61, I think they're going to have targets of about 4,400 and maybe even as low as the 100-day moving average at about 4374. Okay? Getting back to near the August low was lower still. So that would be a bit discouraging, but I think the model is saying, as long as don't beat up more than that, we just want to throw another dart here and give it a chance to be higher in coming weeks. And of course, I'm still bullish into December, and so is the model. We're just dealing with this seasonal stuff that can last into early October. The worst can last in the next 10 days is how I understand the seasonal. And then hopefully that'll blow off and get better. And I'm really not seeing news in the future to make the problem. I think this report is quite important, but I think we're going to get over it in a few days. If it does cause selling in the stock market, I think we'll get over it in a few days and we're going to be okay. And then if it causes upside, fantastic. That we ought to be on our way here for something better. So I've given you some upside potential, some downside potential, given you an idea of some risk. I've warned you more than once here. It may not even be worth having this conversation because the report can cause people to do some wild, crazy things. And maybe the Fed is going to be quite negative and try to hammer things. I don't know. But it is fascinating that this intraday structure, and again, maybe it's not even worth having this discussion, but it just seems like there's a chance this market can be firm going into the close, and that just slightly opens the door here of saying maybe the Federal Reserve isn't going to give us some bad news, okay? And that the market will like it even if it's not all that bullish or optimistic news. The market may like it and move up anyways. Now, how about interest rates? Well, interest rates are not as optimistic as the stock market this morning. The bond market it's backed interest rates off on the 10-year note, but it hasn't backed them off much. It doesn't seem that serious, and it can go either way. But I still think the larger swings in coming days, weeks, are going to be somewhat lower interest rates. I think even if the Fed raises its rate, within a few days, the free market's going to put the rates back down some, okay? But we'll see, obviously. But it wouldn't surprise me to just see rates working lower today right into next week, and I think the stock market will like that. The dollar index is not giving us any clues here. It's basically just waiting on the Federal Reserve. It does seem to be backing off more than the bond market is backing off on interest rates. So, and crude oil, of course, has been a negative here, but it's just kind of hesitating, waiting to see what the Fed does. At any rate, I just thought this was a curious moment, thought you might be interested in just seeing how this works. It would be fascinating to see if this actually works out that way, that we actually have a very fast intraday kind of, an intra-week kind of indication that maybe the Fed isn't going to come out and give us a bad time after all. All right, past results are not necessarily indicative of future results. Again, let's just have some fun with this, not take it all that serious, but there is a setup. And now I've seen other people talking about different forms of analysis that are saying maybe this market is low enough now that it can bounce after the Fed. Past results are not necessarily indicative of future results. Have a great day. Thank you.